Hey everybody, welcome back. We are on Unit 4, the financial sector. We are focused on monetary policy. This is subunit 4.6 and we are on part 4 in that subunit. What we're doing in this video is we're talking about the impact of monetary policy on the nominal interest rate, okay? I just put in parentheses here, the money market, okay? The term nominal interest rate or money market kind of go hand in hand, okay? The vertical axis of the money market is the nominal interest rate. So when we're asked about the nominal interest rate, we go to the money market. And let me even just say this, guys. When you are asked about monetary policy, of course, there's going to be an impact on the interest rate. Monetary policy is focused on changing interest rates in an economy. And our number one model or graph we go to when we're asked about monetary policy impacting interest rate is the money market or the liquidity preference model. Our other graph that we have for talking about interest rates is the loanable funds market, okay? And when we talk about the loanable funds market, it's just not our go-to market when we're talking about Fed action, okay? Now, if we were talking about crowding out effects that come from the government when they crowd out businesses, when they run deficits, loanable funds market, sure. Household savings, loanable funds market. However, when we're asked about Fed policy, okay, or monetary policy, which is conducted by the Fed, our number one tool to talk about what's happening to the interest rate is the money market. Hope that makes sense to you. And that is why a lot of teachers and AP is going to ask a lot of times, hey, monetary policy, what's the impact on the nominal interest rate? Because the nominal interest rate is what is on the money market. Hopefully that makes sense. Let's keep going. Now, let's do this. For this video, let's start off with boom times, with an inflationary gap. I've been focused a lot on recessions, so in this video, let's kind of reverse it. Let's talk about boom times, inflationary gaps. If we're in boom times, what will the Fed do? Well, the three tools the Fed has is open market operations, required reserve ratio, and the discount rate. And what are they going to do if we are in boom times? Well, I've kind of already given it away for the required reserve ratio and the discount rate. They're going to raise both of those up. Why is that? Let's talk about the required reserve ratio. If they raise it, they are making that banks have to hold on to more reserves, i.e. they can lend out less money, and that's what they want to do in boom times. If they raise the discount rate, they're making it more difficult for banks to borrow reserves, making reserves harder to get or more costly to get. So again, they're going to do that during boom times because again, reserves are what banks can loan out, or at least a fraction of their reserves they can loan out. Now, the top one, okay, OMO, open market operations, the number one tool of the Fed. What is the Fed going to do during boom times? Are they going to purchase bonds from banks or are they going to sell bonds to banks? And the answer is they're going to do an open market sale, okay? Why are they going to do an open market sale? They are going to sell U.S. Treasury bonds to the banks in order to pull reserves off of the bank's balance sheet to make it harder for banks to lend. They're going to try to decrease the amount of reserves in the financial markets when we're in boom times. So they're going to do an open market sale. So there you go. This is what they're going to do tight monetary policy, to do contractionary monetary policy. And that's what they do. They do tight, contractionary, whichever word you want to use, monetary policy when we're in boom times, when we're booming, to help stabilize the economy. What's going to be the impact on the money market? Well, before I get into this too far, let me just remind you, I still like the term the liquidity preference model, but these two terms can be used interchangeably. Okay, so what's going to happen? How are we going to manipulate this graph to find out what's happening to the nominal interest rate? Guys, if the Fed is acting, we are going to shift the money supply curve. Remember, guys, monetary policy, what is it? It is a manipulation of money supply to help stabilize the economy. Who's conducting monetary policy? The Fed, the central bank of a country. And so if we're asked about monetary policy or Fed action, guys, we go shift the money supply. So once again, I like to even write the Fed, they control the money supply. What are they doing? Well, they are making lending more difficult. They're trying to reduce loans in the economy to get the money supply to shift to the left. Now, money supply right there, 0, 1. Here's my original equilibrium point. That's my original equilibrium point. I'll bring that over. Interest rate sub-0. When they shift the money supply curve to the left, what's going to happen? The interest rate's going to start going up, okay? The interest rate's going to start going up. And that means we are going to move to the left on the money demand curve. The quantity of money demanded is going to decrease. Why is that? Because the cost of holding your financial wealth in liquid form, in M1 assets, which is currency in circulation and demand deposits, the cost of holding your financial wealth in those asset classes is going up, okay? Why? Because the opportunity cost is going up, right? When I hold that, my financial wealth in M1 assets, currency in circulation and demand deposits, I am foregoing the nominal interest rate. So when that nominal interest rate goes up, that's the cost of me holding my assets in M1 form, and so I'm going to hold less of my financial wealth in M1 form. So that's what's going on. We're moving to the left along that curve, moving to our new equilibrium point, and we have our answer also at the same time. Nominal interest rates are going to go up, and that is the main takeaway. Now, really quickly, let me talk about if we did have bust times, what would have happened. I'm not going to manipulate the graph, just talk through it very quickly. Well, if we had bust times, if we had a recession, these arrows would turn down, right? Open market operation we would do is a purchase. Those things, okay, if we manipulate the tools that way, we would increase the reserves in the banking system, increasing lending in the banking system, getting that money supply curve to shift right and the nominal interest rate going down. Huge takeaway that we should basically know, guys. Just generically, if we talk about interest rates, if we do expansionary monetary policy, guys, we're trying to decrease the interest rates in the economy. I don't care really what interest rate you're talking about. Federal funds rate, nominal interest rate, real interest rate. What the Fed is trying to do is get interest rates in general to go down if they're doing easy monetary policy. And if they're doing tight monetary policy, they're trying to get interest rates to go up, okay? And we can kind of see that takeaway right here. Hope that made sense to you. We'll see you in the next video.